All right, so we're going to talk about insurance today. So this is people ask me, Curtis, what are the different types of insurance? So I'm gonna give you a brief little presentation that we use to sort of break down the different types. And I'm gonna tell you everything I know about life insurance, which shouldn't take long because I don't know that much. Just kidding. So let's look at this. So there's three types of basic insurance. The first type of insurance is term insurance. Term insurance is the least expensive initially. Some people talk about buying term and investor difference, but term insurance is the least expensive initially. But premiums are guaranteed to increase over time. And so what you do is you buy insurance to term in, it's 5-year, 10-year, 15, 20, 30-year term. And so what happens is you basically are paying for two things. You're paying for the face amount or the death benefit, and you have a premium. So that's what you're paying for, just a death benefit. And when the term is up, if you haven't died yet, which is a good thing, by the way, you have to renew it at what they call your retained age. So when the term is up, you don't get anything back. I mean, you paid for insurance, you got insurance, you didn't die. So if you still feel you need to be insured, which you probably will be, you've got to buy some more for another term. And then what you have to do is you've got to buy it at what they call in the insurance business your retained age. So whatever age you are now, you've got to buy it at that rate. And so, term insurance is kind of like renting an apartment. So just like renting is the least expensive initially, but over time, it can be the most expensive. Now, on the other end of the spectrum, there's whole life insurance. So whole life insurance is the most expensive initially. That's relative, but what happens is premiums are guaranteed level. Sometimes that can even go down or stop based on dividends, depending on how you structure the plan. You get a guaranteed bank-like return. Bank-like return. So what happens is, the guarantee rate in a lot of these plans are 3.5%, 4%, and which is actually in today's rates a favorable place for what I call safe money. Whole life is kind of like buying a house, all right? And so why do you want to own a home? Initially, buying a house is more expensive than getting an apartment because you've got more things. You've got you got to landscape the house, you got to light the house, you got to heat the house, all that stuff that goes along with home ownership. But why would you do it? Well, it's yours, okay? You own it. You have control. It's property. It builds equity. So, houses, the market, is traditionally appreciated. So you build up equity by the house appreciating and, by the paying down the mortgage. Well, with life insurance, with whole life insurance, as you pay for it, you're building up basically savings or equity in the policy called cash value. And so you can borrow the equity. Just like with a house, you can borrow, we call it taking a collateral position, but you can borrow against your cash values for whatever you want without reason or cause. And so if you're off of work, or you need a car repair, or if you got enough in there, if you want to buy a car, you go buy a new or pre-owned car. If you've got, let's say, $5,000 or $10,000 of cash in your policy, you can borrow against your policy, go pay cash for the car. And if you're smart, we call this banking, then you would create a payment plan back to the policy at the same rate that you would have paid a credit union or the finance company, and sort of recapturing your money, and turn around 3 or 4 or 5 years later you could do the same thing again. And so there's a lot of living benefits to insurance. It's not just about dying. And so that way it's the least expensive overall. The other thing about whole life is that whatever you buy, what age you buy it at, whole life becomes more efficient. So whatever you buy it at, and you're 30 years old or you're 40 years old, well, if you're 75 or 80, you're still going to be paying the same price. So it's not going to go up. So there's no surprises. You won't run out of insurance at a point in your life where you need it the most. It won't become cost prohibitive. Well, let's talk about, this is what I call a cousin. So these are hybrids. A hybrid is universal life, flexible term, variable universal life, equity index universal life. And universal life is, it's permanent insurance. It's structured a little bit differently than whole life. It's a little bit more flexible. They sort of came out with it in the early 80s as an answer. Yeah, I think the first one was E.F. Hutton as a response to buy term investor difference. So, but you can make it do different things depending on your objective. So if money's tight and you're using it for mortgage protection or something like that, you can structure the policy to make it closer to term or closer to whole life, depending on your objective. Do you just want the protection that and the cash value buildups that permanent policy affords, but you don't quite have the money to fully fund the whole life, or do you want to uh, structure it to hold, to accumulate money faster, so you really can make it structure it to do whatever you want to do. You have to get with a good competent agent that knows how it works, but that's what happens. Okay, premiums are generally level. If you don't fund it properly, that's what universal life, there's a target or there's a minimum funding. Some agents will do the minimum funding. I don't recommend that because you need to make sure there's enough money, because internally the cost of the insurance inside the universal life goes up. So you want to make sure you're funding it at enough to make sure that it will that the policy will be viable long range. So you just have to make sure that you get with an agent that sets it up right and funds it properly. That's all. And you basically like whole life, you'll get your money back. You generally if the you can make money, especially with things like equity index. Equity index universal life has the opportunity for you to participate in the S&P 500, stock index. You're participating, but not in the market. So you're linked to the return. So you're not actually investing, but you get the potential to get the ups of the market without having to participate in the downside risk. So your principal, your money is never at risk. So that's actually a good, what I call, conservative, aggressive strategy. And so with universal life, it's like owning a condo or a mobile home. Still ownership. The payments are generally level. Total costs can go up or down with condo fees or lot fees, etc. So it's similar. You can raise the premiums. You can lower the premiums. There's different riders. So there's a few moving parts with it. And so you need to get with a person to help you to design it right and explain the features to you. You build up equity. That's the other advantage. You still build up equity. You can access that equity tax-free. One of the things people use universal life for is a strategy out there called tax-free retirement, where you're using the plan kind of like, I've heard it termed a Roth IRA alternative. And you can, what's cool about it is that you can you can make it hold more money. Let's say you have money you want to save than like a Roth IRA. So let's say Roth will only hold, I believe, $4,000 or $5,000 a year, and let's say you're willing to save $6,000 or $7,000. You can structure these to hold money, but you're not. You can put the money in and out without a penalty. You can turn around. There's ways to structure it so you get out tax-free income. You can give us a call. We can explain some of these strategies to you. I just want to give you an overview of the different. What I want to highlight to you, that insurance is not just about dying. It's a financial tool. And so there's a lot of living benefits to insurance. Although it is a loved product, and you want to make sure that priority number one, you want to be protected, because most people out here are underinsured, do not have life insurance, and I hate to break it to you, none of us are getting out of here alive. Okay, so you might as well bet on certainty, but use it while you're living, and then learn how to if you're able to pass on generational wealth. And that's really one of the powerful things about insurance. It's the only product that makes sure what you want to have happen will happen. All right, and so you generally get your money back with permanent insurance. So selecting the best insurance plan for your unique situation basically says you got to ask yourself this: who do you need to protect? You have a family, you got kids, you're a lot of people want, to make sure their grandparents that want to buy insurance on their kids because they know that they'll be responsible for them should something happen. It's a lot. You got business partners, buy-sell agreements, partnerships where you're in business together. There's a lot of different needs for insurance. Is it a long-term need? Is price more important than value? Is budget tight, but you need protection to see? Then you're looking at more of term insurance initially, because you can also, if you turn out that you like permanent, you can convert it with the right. It can be converted over to a permanent policy. But the most important thing is that people don't wait, because you have to qualify for this stuff. So you I have people that don't understand. They're, get every year you're getting older, or people are borderline health situations and they want to put it off, and they have the money. They just not are understanding that you have to qualify for insurance, and insurability is not guaranteed. I had a client once that was in late 20s. The wife wanted to get it. He was hemming and hawing. Then they called me, Curtis, we want to get some insurance. Well, here's the problem. Now something happened. He became a I think it's type 2 diabetic. He has to take insulin. And with the company I was with at the time, he didn't qualify anymore. And so you have to look at that. You can still get it if you've got type 1 or type 2, but it's going to cost more. They're going to rate you, which is another whole other topic. But there, you just got to go. There are companies that'll do it, but now you're going to pay a little bit more for it because your health is bad. So you want to get it when you can get it and lock in your insurability. The younger you are, the less expensive it is, and the healthier you are, and you don't smoke, they reward you for that with lower prices. And so you want to ask yourself, will this help me save more money for my future? And so, what makes sense for your situation? So if you've got any questions, I'm Curtis May. Give us a call, 610-622-3121. And I hope this helped give you a quick foundation, all you never wanted to know about life insurance. All right. Take care.